Top three things in Keith's notebook. Number one on the list is the U.S. dollar. And, as we like to say, the dollar continues to burn. So burn, baby, burn. U.S. dollar, I think, is now at a 5-month low and continues to front run just as rates do what we think will be a more dovish Fed. And on that note, Janet Yellen is speaking today at 12:15 in New York. So keep that on the radar screen. We think what's going to happen is on the margin, there'll be less tapering come summertime. And as we all know, inflation slows growth and the Fed will get easier to devalue the dollar. When growth slows, we'll get more of what's already been happening. The XLY consumer stocks down 6%. Slow growth will start to chase yield. And, that's why utilities are up 12% year to date. We think this is all kind of front running what will be a policy move next. Second thing in Keith's notebook is oil. Both Brent and WTCI up this morning, up 1% and 0.7% respectively. And they're confirming in our models what is a bearish to bullish trend reversal. We like these. This is sort of an important indicator for us quantitatively for stocks and asset classes, but the consumer obviously doesn't. As we all know, inflation is an unlegislated tax that will continue to matter to the 80% of Americans that are getting crushed by it. We've already seen rampant food inflation, and it looks like oil potentially and gas at the pump is next, which isn't good, particularly going into the summer driving season. Then the third thing in Keith's notebook is the U.S. 10-year yield. Not a major move overnight, but the yield is down again to 2.64, so down about a basis point. The interesting point is just in the context of both a rally in the NASDAQ and Russell, albeit on low volume. What this kind of confirms to us is that the low volume rally was really just that, a low volume rally, kind of a bounce off the bottom, and it really hasn't changed what the foreign exchange, bond, and equity markets have been signaling and pricing in, which is slower growth sequentially into Q3 2014.